Hey everyone, this is Kirk here again at OptionAlpha.com, and in this video we're going to talk about single versus multi-leg option strategies. So single calls and puts, as we've talked about many times before in track 1 here, are the building blocks for every possible option strategy you might want to use in the market. And although single leg option strategies like buying one put or selling one call are more than fine to use, when we start combining options of different types and strikes, we have the ability to create multi-leg option strategies that profit from whatever assumption we have about the stock. Now, more importantly, we can both define our risk and increase our profit potential or our return by using multi-leg option strategies. And today I want to go through at least 2 examples of these, because there's a million that we could probably go through, but 2 examples of these that we could really define our risk, increase our return on capital, and use these multi-leg strategies. But before I do that, we want to first talk about market trade-offs, because in any efficient market, there are trade-offs that you have to make. And I think this is important to understand because there's no free lunch in the market, meaning that you can't just get $10 of potential profit without taking on any risk. And I think it's really important at this point in the process here to cover these market trade-offs. All right, so the first set of dynamics that we're going to talk about is risk versus profit. Now, here's the deal, and this is how it works. Most people don't really understand this, but when it comes to the options market, when you reduce your risk or you push down the risk that you have in the trade, you also reduce the profit that you can potentially make. Okay, now this is expected profit that you're going to make. Same is true in the reverse. So if you increase the risk in your trade, then you could potentially make more money. And that's just how it works. Okay, so there's no free lunches here, meaning you can't reduce risk and dramatically increase the amount of money that you can make or your profit potential. Now, the second thing that I want to cover in this market trade-offs is the difference between profit potential and probability of winning. Now, the reality is, and this is the one that I always subscribe to in the way that I trade, is that when I cap or reduce my profit potential, okay, we're not talking about eliminate your profit potential. We're talking about instead of making $1,000 on a trade, I'll be okay making $250 on a trade. So limiting my profit potential. When I do that, I increase my chance of winning or my probability of winning. And again, we'll prove this here with some real trades as we get further through this training. But that's the most important aspect you have to understand in the options market, is that when you cap or limit your profit potential, you increase the chance of winning on a trade. Same is true in reverse. When you want to increase the potential money that you make, you dramatically limit your probability of winning or reduce your probability of success in a trade. Okay, key concept. And then finally, we have to talk about ROI. So the reality is that when you have a lower ROI because you have more risk in the trade versus how much money you can make, again, lower ROI generally correlates with a higher dollar value as a winner. So what this means is that my ROI on a trade might be 2%, but my dollar value winner on that trade might be $250. Okay? And again, this is just conceptually, not like real numbers, but that's what we're talking about here. When you have a low ROI or what looks like a low ROI, conceptually, you're going to have a higher dollar profit to get there. When you have a lower dollar value as a winner because you're shooting for a higher ROI, what you end up having is you might end up having, let's say, a $10 winner, but the ROI on that trade is 30%. Okay, I'm not saying that one is necessarily worse than the other. Okay, because in this case, with this ROI versus dollar value, you can make the argument that you can trade more and all this other stuff, do more contracts. The reality is, though, is that you have to understand that higher ROI strategies equate to lower total profit and dollar value. In my opinion, I'm concerned really about how much money I'm making on my portfolio, meaning how much dollars I'm taking in. Yes, I'm concerned about the overall portfolio return, so don't get me wrong with that or misunderstand what I'm trying to say. But me personally, since I generate income from my portfolio, I'm more concerned about saying I generated $3,000 of income versus saying I generated a 30% ROI that only ended up being 10 bucks. Okay, so that's really the key here. Now, again, as we continue to talk about multi-leg strategies, I first want to lay the foundation with these short building blocks. Okay, so if we're going to go out and we're going to do some sort of option selling strategy, because again, we've already kind of talked about why we should be option sellers, why we should be net option sellers. We've done that in our What's Our Edge video. If you haven't already seen that, that's the one probably directly before this video in track 1, unless we've moved things around. But that's important to look at. And we're going to be talking about why we should be option sellers from here on out through this track and everything else that we do here at Option Alpha. But let's start with a short call option, because I want to really go through the particulars of doing just a single leg strategy versus now how we can shift and change risk and dynamics as far as payoff and all of that stuff as we look at adding different legs to this strategy. So this is just a single short call option strategy. So let's do this. And you guys are familiar with this payoff diagram, but basically what happens is that with a short call option, you have limited risk and you have limited profit potential and unlimited risk. I mean, the stock can rise, to infinity if it possibly can, and you would carry that risk throughout. But again, with limited risk, now we have a high profit potential or probability of profiting on this trade. So let's use some hard numbers because I think it's a little bit easier to understand when we're actually looking at trades versus hypothetically looking at stuff here. So we're going to use EWZ for today's case study. Why EWZ? Because we just picked it randomly. It's fairly high, got good implied volatility, so we're going to take a look at it. And EWZ is just a Brazil ETF, okay? But we're going to go here to the May contracts for EWZ, 58 days to go until expiration based on when we're doing it now. And we're going to sell just a single naked short call option in EWZ. And this is going to be the 28 short call options. Now, based on what we know about EWZ, its implied volatility, all of the historical moves of EWZ, and everything that we can factor in, our broker platform tells us immediately that the probability of losing on this trade is 29.04%. This is our probability of being in the money on this trade. So again, our broker platform does this. A lot of broker platforms do this. We've got a video if you want to know how to use Delta as an approximate for that. Just search in our platform here at Option Alpha. You can check out that video. But again, our broker platform tells us immediately that there's a 29% chance that we lose on this trade, or 29% chance that EWZ goes from 25.82 all the way up to and beyond our strike price at 28 by expiration, again, which is 58 days to go. Okay, so all these numbers are known. So if we basically have a 30% chance of losing, so I'm just rounding up here for even numbers, that means that this trade has about a 70% chance of winning. Okay, so 70% chance of success on this trade, meaning there's a 70% chance that EWZ never goes from 25.80 all the way up to our strike price of 28 between now and expiration. That's just how the numbers work out, okay? So in this case, if we were to sell a short call option in EWZ, we might pay for that short call option, let's say $1, or we might receive $1 or $100 for that option, okay? And just using round numbers here. So it's just a single leg strategy. We take in $1 or basically $100 of option value here to get into this trade, okay? That's our max profit potential. You notice we can't make any more than that credit that we received. Our max loss is technically infinite, but the broker can basically look at our, the probabilities and all that stuff, and they basically hold what's called margin or buying power. Now, we talked about this before in other videos. Again, if you need some more specialized training in it, search the platform here at Option Alpha, and we do have additional videos on that. But they hold what's called buying power effect or margin to carry this position. So they basically hold in our account $290 in reserve to cover any potential loss in this trade. Okay, so now you can see that this is our potential profit in this case, and this is our potential risk in this case. All right, right now, that's how much the broker is holding in reserve. So if we divide 100 by 296, we're looking at a return on capital, or an ROI, of basically 33% if we entered this trade. Okay, so we're looking at a return of about 33% if we enter this trade. Again, this is all the brokers holding in margin, so that's how much they take away from our account value until this trade closes. So 100 divided by this number is 33% return. And again, we've got a 70% chance of success on this trade. Okay, not too bad. 70% chance of success, 33% chance of our return on our capital being used. Okay, so again, just kind of showing you the broad strokes here. We'll get back into this here a little bit more. Now, if we go and look at a different option, and then we'll combine these two together. If we go and look at just a single long call option, okay? A single long call option now has reduced risk, meaning limited risk to the downside, and potentially unlimited profit potential. Now, remember what we talked about before, is that when you have a lower risk and you have lower generally expected profit potential, okay? In this case, the payoff diagram for a long call shows that you have unlimited profit potential, but we're talking about expected profit. How many times are you actually going to win? So again, if you have a higher profit potential in this trade, you've got a lower probability of winning on that trade, okay? So again, let's look at the long call option now inside of Thinkorswim, and now let's look at, say, that same strike price of 28. Now, if we buy this contract for $100, okay, we're going to take the complete opposite side of the trade. So instead of being an option seller, we just buy this contract for $100. Now, when I hit confirm and send, what you'll see here is now everything is switched, right? Now, my max loss is $100. I can't lose more than $100. And my profit potential is virtually infinite, okay? Because the stock can theoretically go to infinity. But the reality is that on this $100 trade, I've got only a 30% chance of making money. Remember, there's a 30% chance that the stock closes from where it is now up and above my call strike. Remember, I'm an option buyer at this point. So there's a 30% chance that this trade goes in the favorable direction that I want it to go. So if we take a 30% expected move times our investment of $100, we're looking at a profit potential maybe of $30 in this trade. Okay, so again, 30% expected win rate, and our profit on our investment here is $100. Then we're looking at about a 30% expected return or profit on our trade, but with only a 30% chance of happening. Okay, so if we win, maybe we win 30 bucks, 30% chance that actually happens. Okay, so now you can see individually some of these things start to work out. Some of the numbers are starting to make a little bit more sense. Okay, now again, individually, each one of these positions, whether you do the short call option or the long call, they each have their benefits and drawbacks. Okay, in my opinion, I'm always an option seller more than I'm an option buyer, so I prefer, given the choice, a short call option. Higher chance of success, a little bit better payout generally. In that case, as far as expected return and payout when numbers actually play out. So that's why I prefer the short call. But what we can do is we can actually overlay and add these two strategies together. And what we can create now is called a call credit spread. Now, many of you who are familiar with options trading are a little bit more familiar. You'll know that call credit spreads and put credit spreads are some of my favorite strategies to trade. The reason I like to trade them is because they are high probability and they have defined risk, okay? High probability and defined risk, meaning you can see on the payout diagram here, you have defined profit and you have defined risk, okay? So once you get into the trade, you should know exactly what you can make, what you can lose, the probability of winning, losing, the whole deal, okay? So that's why I like them a lot. And basically what you're doing here is you're selling one call option, okay? And that gives you this payoff diagram that looks like this part of it. Okay, so that half of it. And then you go out and you buy one call option. And you buy one call option at a higher strike. And again, we do have video tutorials on this, so you can basically, see how we do this in different videos. And we'll go through this here again today so you understand it. But you buy one option, you sell one option to create a call credit spread. Now, the key here is that we're going to take in a credit. So whatever we do, we have to net sell options. And that's always our strategy here at Option Alpha, is to net sell options. So if we go back to this pricing screen here for EWZ, what we can do now is we can sell the 29 calls, which are here, and we can go out to a different strike and buy the 29 strike calls. And what that's going to do is that's going to create a call credit spread for us. Okay, so now we do this trade where we add these two together. So now we're doing a complex or multi-leg strategy where we sell one option, we buy another strike call, and now we get the difference in price between buying and selling. Remember, it still always works out numbers to numbers. So if we sold this option and took in $100 of premium, or roughly $100, and now we buy this option for $75, we're basically looking at a total net credit that we took in of about $25. Okay, so total net credit of about $25. And hopefully you see where I got that. Now, in this case, if I hit confirm and send, you can see that our numbers are a little bit different. Our max profit potential, since we're still net selling options, is still limited to the credit that we receive. So this is our max profit potential of $25. We can never make more than $25 on this trade. But by adding that long call option at 29, we basically have protected ourselves from any upside move beyond 29 in the stock. And what that does is that limits our risk to just $25 for this particular trade. Okay, or I'm sorry, $75 for this particular trade. So in this case here, this trade, based on the profit that we make and the return and the risk that we have, still are making that 33% profit ROI. Okay, so it's kind of interesting when you look at it, it's still the same ROI as the short call option, has still virtually the same break-even points as the call option, okay, as the short call option. But now the difference becomes that we have limited risk. So now we're only risking $75. Now we can only make, because we have limited risk, $25. Again, so we have less risk in the trade. Now we have less profit potential in the trade as well. So going back to this, we have in this trade, we have less risk in this trade. So we have less profit potential. The other short call option had greater risk and greater profit potential. Still had the same ROI, it's just the distribution was a little bit different. So here's the key. If you want to trade the credit spread because you want to be a small investor, or you have a small account, and you only want to limit the potential money that you can make to $25 because you have a small account, and you're okay accepting $75 of risk with a 70% chance of winning, this might be a good trade for you. If you've got maybe a slightly larger account, you can handle a couple $100s of risk to make a little bit more money per contract, then maybe you go with the short call option in this case instead of the credit spread, okay? So again, the key here with these credit spreads is that, and any of these multi-leg strategies, is that they basically give you the opportunity to create a payoff diagram that is acceptable to you. So basically, you create a payoff diagram that kind of fits with you, with your risk-reward profile and where you think the stock might go. So another quick example of this before we kind of wrap up, or another two examples of this. First is an iron condor. So now an iron condor just takes this to the next level. And now what we're doing is we're doing basically a credit spread on both sides of the market. So we're doing a call credit spread and we're doing a put credit spread down below the market. So now we're combining these two strategies and basically saying, look, I think the market is going to stay range bound, right? With the call credit spread, you were assuming that the market trades anywhere below your break-even price and your strike prices. So you are generally neutral to bearish on the market. Remember, if we sell the 28 call spread, 28-29 call spread in EWZ, EWZ can trade from 25 up to 28, just can't trade past it. So we are basically neutral. It can be a little bullish, meaning the stock can rally, but we're neutral to bearish. That's ideally where we want the stock to go. If instead we look at doing the iron condor, now we can create a strategy that says, look, I think that the market trades between 2 points, whatever those 2 points are, here and here, right? Whatever you want to create. So these multi-leg strategies give you the opportunity to basically build out this potential payoff diagram that is based on your risk profile potential and where you think the market might go. Now, one final variation in this, and just another example that we can use here, is a butterfly spread. So unlike the iron condor, which may have a bigger, wider potential profit range. And again, I'll just go back here so you can see a bigger, wider potential profit range. You might want to trade off to a butterfly spread, which has a more narrow profit range, but potentially make more money. So again, that trade-off between higher probability of success and lower payoff, right? Or lower potential range that it could trade in. So you're only really trying to pin the stock between two very narrow points. But if you do, then it pays out really big, okay? So all of these different things can factor into how you build option strategies. And again, we can't cover everything in this one single video here in track one, but the idea here is that multi-leg strategies give you basically multiple options, no pun intended, or multiple choices as to how you build out different strategies. So hopefully you enjoyed this video. If you have any comments or questions or feedback, please let me know. If you love this video, please take the time now to share it online. Help spread the word about what we're trying to do here at OptionAlpha.com.